How debt makes you wealthy. So in my previous video, I covered about how credit cards can leave you feeling trapped. But in this case, we're going to talk about how is it the opposite effect, meaning is how debt can actually make you a lot more wealthier and achieving your financial goals easier in the first place. Now first, you got to understand, how do you define good and bad debt? So this depends on a few things. The differences are based on two key factors, risk and cost. Bad debt typically involves high risk and high cost. For example, credit card debt, with its high interest rates, is a common form of bad debt. Everyone can agree to that. Now next goes to car loans. Car loans is also considered bad debt because they are used to buy assets. Assets like cars can lose value over time, but keep in mind this only applies for most circumstances, and not all cars depreciate. For example, if you bought a limited edition Pagani or Bugatti or Koenigsegg, those will appreciate value over time. But if you bought something like, let's say, your Tesla, or you buy like the Toyota Corolla or Toyota Camry, majority of the time they will depreciate, and as an asset you'll lose money over time. Now, a good debt is where you borrow that enhances your financial well-being. It's usually associated with lower risk and reasonable cost. Debt can also help you reach your financial goals. Here are a few good examples of home debt, which is considered could be good debt in this case. Now, first you gotta understand, what is home debt? Home debt is to borrow money to purchase or finance a home, which the majority of people will do when purchasing their first property to stay in. One important note to keep in mind, which already most people will know, that home loans come with interest rates. Now, which can be a fixed rate, which means it remains the same throughout the loan term, or a variable rate, meaning a rate can change. Now, for example, now where the economy is doing really bad and it tries to press home buyers so the home prices don't spike out of control, is where they raise interest rates. So imagine where someone tries to purchase a home, instead of paying an interest rate of around 2%, now to pay 7% of their mortgage. Of course, a lot of people will hesitate to purchase a home. Once it gets high enough and they can't leverage their money, then of course this is artificially suppressing the buyers. So home buyers typically need to make a down payment, which is a percentage of a home's purchase price, usually around 20%. Now, a larger down payment reduces the amount borrowed and can lead to better loan terms. For example, if instead of paying 20%, you can pay a higher percentage, like such as 50%, which will lower your monthly payments. Now when you take out loans, you can take it out in different type of variables, meaning in different years, or such as 15, 20, or 30-year loans. This will affect your monthly payments and the overall cost of the loan. For example, if you took out a 15-year loan instead of a 30-year loan, you will pay a higher interest rate because you are paying that loan within 15 years instead of 30 years. And of course, if you're gonna do it that way, then you have less time. Personally, I will choose the latter, the longer amount of time, because you always have the option to pay off the loan right away. Which in the same time this relates to debt, because debt and home equity all relate together. Now, if you look at it this way, homeowners will have to make mortgage payments, which build equity in their homes. Now, equity is the portion of the home's value which they own outright. When buying a home, you should have an emergency fund to prepare for damages on a home such as electrical, water, termites, and etc. It provides a place for you to live and build wealth simultaneously. For example, you can build credit, paying off your home mortgage. Instead of having like different types of payments such as credit card, you can also use your home payments also to keep a record and build up credit score. Now, over time, as your mortgage balance decreases and your home value appreciates, your net worth can grow with a fixed rate mortgage. Your monthly housing costs remain relatively stable over the life of the loan. This stability can provide a sense of financial security. You don't have to worry about rent, for example, stable housing costs compared to which majority of the people are suffering today. So like imagine you go rent a place. When you rent a place, they can charge you rent different based on the previous tenants. And if, let's say, the HOA or the owner of the association or the owner of the building decides to change hands, they might change the rent, which you have no control or no power over. And if you get placed with rent control, that's a whole entire different story. Now, moving on, another good example of good debt is leveraged securities. So the easiest way to explain leveraged securities is basically borrowing money to use to make you more money in the return of investments, which a lot of billionaires and really wealthy millionaires take advantage of. The most common type of leveraged securities are margin accounts in the stock market. Now, you have to be very careful when you do not want to put yourself in a situation where you do not have the money to pay off the leverage, or you end up selling your stock because of it. And this is a really risky move. Make sure to speak with your financial advisor before you make your financial decisions. But if you understand what you're doing, and with a good understanding, you're able to leverage and to use that type of income to increase your potential return and get more for your money. Now, here's a few more good examples how good debt is actually part of student loans and business loans. Now, first we gotta look at student loans. Student loans can actually be really beneficial for your credit score, and it's considered part of a good debt. Even a lot of people, like you look in the media, it's basically all student loans are killing people, student loans are destroying the economy. But yes, there's two parts of that equation. Now, first, let's look at the good side. So when you invest in higher education, which will lead you to increase in earning potential, education can also enhance your career prospects and your earning capacity, such as making an investment for your future. That's a good part about student loans. Now, the bad side of student loans is if you cannot pay that off, or you choose a wrong degree, then you're basically digging yourself a hole. Now, break it down to the next one. Small business loans. Now, how do small business loans help you a lot? This can range from small, medium, large, but specifically we are looking at small business loans. Now, small business loans, a lot of people need money to start up a new project, a new investment, maybe to have a career in mind. Now, when you start to borrow money to start your small business loan, you start to expand your small business, can form into a good debt. When it's used wisely, your business can grow and generate profits. For example, maybe you want to open a boba shop. You open a boba shop, you need money to get rent, get the materials, get the kitchen appliances, then you may need to pay for advertisement, maybe you need to find a good accountant. When you charge $5 to $6 and you got a lot of people coming in, then you pay it off. Then you're able to pay off that loan. When you pay off that loan, and when you do pay out that loan, when you need to make another borrow or make another big purchase, which requires you to now take another loan, they can check your credit score. And when you see your credit history, you can have a track record of payments you made on time. That's a benefit. Each time you take out a loan, there's a positive and a negative side. I hope you guys found this video informative, and make sure to share this video with other people. Maybe they might learn something from it. So I hope you guys have a nice day. I'll see you guys next time.